Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at WisdomTree Asset Management. U.S. credit, we are not in uncharted territory. While the money and bond markets continue their Fed-watching saga, there's one constant we've been emphasizing for the fixed income landscape, and that's the new rate regime. Now, an integral aspect of this investment setting is that despite what the Fed may or may not do, rates appear to be on course for staying higher for longer. And it's against this backdrop, investors have been trying to determine where should they allocate funds in the fixed income universe, specifically here within the U.S. Now, typically, one can break down the bond market into two distinct sectors, interest sensitive and credit sensitive. I've been spending a good amount of time in recent blogs and podcasts on the interest sensitive side of the equation, so I thought it'd be a good idea to adjust trends for U.S. credit. Now, a key gauge when we're measuring relative value in U.S. corporate bonds is to look at spread relationships when compared to Treasury securities. These differentials, they can help determine where current corporate bond yields may reside in relation to historical levels. And this analysis applies to both the investment grade and high yield universes. So for reference, a narrow spread is oftentimes viewed as a sign that corporates could be leaning towards being expensive, while a wider differential would be viewed as the opposite or comparatively cheap. Now, throughout the better part of this year, there's been a sense among investors that U.S. corporate bonds appear to be more on the expensive side of the ledger, and that's due to the fact that both investment grade and high yield spreads have been visibly narrowing since late October. Just to give you some perspective, investment grade spreads have declined over 40 basis points, while high yield differentials have fallen roughly 140 basis points. Now, their current respective levels of 87 and 300 basis points place them at the lower end of historical ranges. And this is where things get interesting. To listen to some of the current narrative on the subject, one could be forgiven for thinking the current readings are an unusual development. However, if you look at things from a historical perspective, you find out that corporate spreads are definitely not in uncharted territory. In fact, there's been a variety of periods in the past where corporates have traded at these levels, and in some cases even lower. Now, I'll be the first to admit that based upon these current spread readings, U.S. credit is not necessarily cheap. But the resilient economy and somewhat favorable fundamentals seem to suggest they're not necessarily overly expensive either. In fact, using history as our guide, as long as the economy doesn't fall off the cliff anytime in the months ahead, investment grade and high yield spreads could continue to trade in their present respective ranges, but we would emphasize a quality screened approach. Now, if the fundamental backdrop can be maintained, I could potentially argue that a visible rewidening in spreads could be viewed as a buying opportunity, much as we had seen in pre-COVID trading. So to wrap it up, for investors looking to allocate into U.S. credit, here are two quality screen solutions to consider. The first one is the WisdomTree U.S. Short-Term Corporate Bond Fund, ticker SFIG, and that's a means of taking advantage of the inverted yield curve and the potential for Fed rate cuts. The second one is the WisdomTree U.S. High Yield Corporate Bond Fund, ticker WFHY, and that's a core plus solution that aligns favorable fundamentals with income needs. So I'm going to wrap it up there. I just wanted to give everybody a little bit of sense what's going on in some other parts of the fixed income arena that haven't been touched upon of late, and hopefully provide some solutions to consider. Have a great rest of the week, everybody, and be well. And before investing, carefully consider a fund's investment objectives, risk, charges, and expenses contained in the prospectus available at wisdomtree.com/investments. Read it carefully.